I'm Stephen Katz with Van Dyke Mortgage, and I want to welcome everybody here this morning. And we're going to have three terrific speakers. I'm one of them, calling myself terrific as well. And then we're going to have Jason Frazier come on, and he's going to tell us about social media marketing. And then our keynote speaker, Steve Richmond, is going to delight and amaze you with his presentation. So my portion's a little bit dry, but rest assured that it gets more and more exciting as we go on. So economics of the housing market. This is what we hope you take away today. Are we in a real estate bubble? So that's probably a question that we get all the time, both real estate and mortgage. In fact, according to Google, the third word that's most commonly searched after real estate is the word bubble. So obviously that's on people's mind. Where are interest rates headed? This is the million-dollar question. We're going to give you our thoughts on the subject and hopefully nail that down. And then we have some tools and resources that are available to you as real estate agents that will help you when you present your offers to the sellers. Ta-da! Does today's housing market resemble 2006? Were any of you in the business in 2006? Steve, I know you're
No, I just answered the question.
Okay. Are you familiar with what went on in the real estate industry in 2006? Okay. So there are a few things that are similar today that we want to keep an eye on. First of all, this is the Case-Shiller Index of Appreciation. Case-Shiller is kind of the gold standard. And it shows that not only are values going up, but the rate that they're going up is accelerating. You see 10, 11, 12, 13. These are rolling 12-month returns, and it just keeps going up, up, up. Very similar to the way it did in 2006. Values went up, up, up. Then that chart went to May. Then even in July, it was higher again. We're looking at over 19%. The benchmark takes the top 10 cities, and then 19.95 is the whole country. So appreciation is accelerating just like it did in 2006, but there's a difference. Today we have record low inventory. Back then, you can see this line right here. This says 07, but right here, 06 and 07, we had 3.7 million homes on the market. Today, we have less than half that many, average being around 2.5 million. So you see how we were overbought, overproduced as far as homes go. This record low inventory is what we're all suffering with. That's creating the extreme demand. Why do we have such low inventory? Well, after the real estate crash in 2006, a lot of builders went out of business forever. They blew up their relationships with their lenders to a point of no return. But even with lower production, we got hit double whammy. If you look at this during COVID, a lot of builders just shut down. So we took a bad situation and made it worse, and that's why it seems like as the virus came along, so did our housing shortage. On the other side, when you look at measuring how, I guess, bubble-licious the market is, you look at two things. You look at the supply and the demand. And right now, what we estimate is that the average age of a person buying a home is 33 years old. That's right here. And you can see that the demand has risen and that it's going to keep going for several years into the future. So demand should stay strong. Now, I know what you're thinking. Steve's over there giving me this look because he knows that home prices are up 41% since the highs of 2006. You're going to have an affordability problem. And then when homes are so expensive, people can't afford them, well, then there goes your demand, right? Well, like this guy right here. It's got windows, I don't think I can afford it. But there's a couple other factors at play. Number one, back then, rates were at 6% in 2006. Today, this says under 3%, we're right around 3%. So interest rates are much better today, which is helping affordability. And incomes are up 55%. The average hourly wage earner made $20 an hour back in 2006. I know these dates are impossible to read, but I'm telling you right here, this is 2021, that hourly wage earners are up to $31 an hour on average. Now, I think we can all agree that people in the market for a home are probably making more than hourly wage earners, so their income is up even more. So when we look at affordability, we see that in 2006, the average family spent 30% of their gross monthly income on their mortgage payment. You know, in the business, we call this the front ratio. In 2021, they're only spending 19%. So homes, even though they're more expensive and they've gone up so much, they're much more affordable. So affordability is not going to cause a bubble for us. Okay, the other factor is, I hope, and I'm proud to say, lenders are a little bit smarter now than we were back then. Back then, this blue represents the risk of the borrower. That's kind of the standard borrower risk. And then the red was the extra risk that we threw on top of it with the no down payment, stated income, no income, no asset loans. Do y'all remember those, or is that before your time? I mean, basically, if you could fog a mirror, we had a loan. When that phone rang, that person could get a loan. Okay, that's how we were. There was such demand for mortgage-backed securities back then. Of course, you know, what could happen, right? So you see 2006, how much the risk on this chart shows compared to, this goes to 2020, where we have basically done away with all those fancy schmancy programs, and now we just do regular, what we call agency, Fannie Mae, Freddie Mac, FHA, and a few what they call non-QM loans, but it keeps the risk very low. The other thing that helps us stay out of bubble territory is the fact that with the rising values, homeowners have a lot more equity than they have in the past. You can see, we see back then, 2006 did similar. As values went up back then, people got more and more equity in their home. And then now, same thing that's happening, all of a sudden our homes that we had small down payments, now we have a huge savings for us in the way of equity. So foreclosures are low when equity is high. So you're not going to let the bank take your home if you have $100,000 in equity. You have options. You could go get a second mortgage, or if you were in dire financial straits, let's face it, you could sell that home at a profit in two weeks' time. Steve, don't give me that look, because I know what you're thinking.
No, is that not working?
No, it's working. It's working. I know what you're thinking. You're thinking, yeah, but in 2006, people were using their home like a friggin' ATM machine, right? They were sucking all the equity out to buy cars and boats and all that stuff. So it is true that we had a lot of tappable equity. And when we say tappable, we're talking about the equity that's over 80% loan to value. And today, it's even higher, $7.3 trillion in tappable equity. But for whatever reason, maybe people learned their lesson or they got a little smarter, you can see that they're not accessing that equity near as much. Cash out refinances are nothing like they were in 2006. People were drawing cash out of their house like crazy. So you can see that it's only 2% versus 7%. Homeowners are keeping their equity in their homes. What do you think about that argument for we're not in a bubble? Pretty solid. Any questions about the bubble state of the market? Okay. So our next topic, where are mortgage rates headed? So this is a little bit complicated because we got a lot of things going on. Okay, she's back. Does everybody know who this is? Does anybody know who this is? Go ahead, tell us.
It's our person in charge of money, what's her name?
Right, Janet Yellen.
Yeah.
Aunt Janet.
So she was,
It's Aunt Janet.
so the thing is, she was the Fed chairman.
Yes.
And she wasn't too bad because she was what we call a dove. A dove is somebody that wants to keep rates low and that is easy on inflation. And does anybody know what the opposite of being a dove is? It's called a hawk, which is a term for they're going to be very hawkish on keeping inflation low. So anyway, so she was kind of our friend when she was Fed chairman, but now she's Treasury Secretary. And things are a little different. She's a spender. She never saw a government program that she didn't like. And whether you like her or not, you carry around her autograph because as Secretary of the Treasury, her signature is on all her money or something. So we believe that rates will stay low, but could be a rocky road. Here are some things that we definitely want to keep an eye on. The post-COVID economy growth drove rates higher a little bit in the second quarter of 2020, of this year. And that's because we shrunk the economy like crazy during COVID. People started to go back to work, businesses opening up, and that kind of gave us a little bit of a shot in the arm. The hotter the economy, then the more pressure on rates. Stimulus checks went out to everybody, so they pumped money into the economy, which was great, but the stimulus was short-lived. Okay, additional spending from the federal government. Does anybody know how much the vaccines cost? Nobody knows. I mean, it's like a national secret or something. But you can bet that if you buy 100 million of anything, it costs a lot of money. So additional spending by the government increases the supply of treasuries to be sold. If they flood the market with these treasury bonds, then it puts pressure on interest rates. Now, a lot of people say, they use that term, well, the government's just printing money. But the government actually does not print money. The government issues debt. So when the government needs the money to pay for the COVID relief, then it issues these bonds to the Treasury Department, and that's how they get the money. So what we may see is rates likely to bump higher for a short term, but then resume their downtrend. There's actually news pulling in both directions. If we just look at where rates are today, we see that from about October of 2019, basically beginning of COVID, we've kind of been range bound right here, right? Hugging that 3% line, and today they bumped up just slightly above 3%, but that's where we are, not too bad. What do the experts say? Besides my opinion, here are the prognosticators from Fannie Mae to the National Association of Realtors, and you can see that they're still very range bound, somewhere in the 2.95 up to maybe 3.25. So the average being 3.14, which we just looked at, is pretty close to where we are now. Okay, one thing that gives us a little bit of confidence is this is an economic certainty that as debt increases, and the country is taking on debt like crazy right now, interest rates stay low. And it's kind of counterintuitive, but it always works that way. The additional spending causes a short-term boost to the economy, but then it becomes kind of a drag on the economy. And the Fed usually will keep rates low once we get through this short-term inflationary period, which brings me to the next topic, where they like to say inflation is transitory. We'll all see higher prices at the grocery store, at the gas pump, and all that. And there's a lot of discussion whether this is here to stay or whether it's what they call transitory as we come out of this COVID economy into a more normalized economy. So we feel like supply chain issues will eventually be resolved. The labor force participation rate will rise back to pre-COVID levels. The labor participation rate is interesting. It's at 61%, which means that amongst all adults, 61% are working. Or you could say 39% are not working. Typical, it's around 66 to 68%. So we've still got to get that 4 or 5% of the population back working. The other thing, and you can't avoid it, is Jerome Powell, who is the Fed chief now. He's going to do everything to keep inflation in check because this is the administration that put him in office, and 2022 is an election year, and he's going to be hawkish when it comes to inflation. So we feel it's a good time to buy. I mean, of course, we're all in the mortgage/real estate industry, but I think you can tell your buyers that with confidence. Interest rates are going to remain very favorable. We already talked about there's high demand, which is going to continue, and tight supply. It's going to take builders minimum 3 years to catch up. This is going to lead to further appreciation in 2021 through the end of the year and in 2022. Home affordability is still excellent as wages have risen, even to a greater point than the home prices have gone up. So here's a couple tools and resources that realtors can use that I think will really help them out. So, cost of waiting. So, who out there has made 3 or 4 offers for a buyer and they don't get any of the homes and they get frustrated? You ever have that happen? They get frustrated. And I mean, it's emotional, right? You're looking at a home, you're thinking about your family living there, and then it's gone. And then you do it again and it's gone. And then any of them ever say, you know what? The market's so chaotic. Let's just hold off 6 months or a year. I'll renew my lease, and then we'll come back a year from now and we'll try this again, and maybe everything's going to be settled down. Well, it may be settled down a little bit, but it's going to cost them a lot of money. So this is what we show. We're forecasting going forward that the appreciation rate is going to be 8.81%. Somebody smarter than me came up with that number. So if they're looking at a home that's $450 and they wait 1 year, that home's going to cost them $489,652 on average. Also, over a year's time, we're expecting interest rates to go up a smidge, maybe to 3.375. So what does that mean? That means that they're going to end up paying $255 more a month for that same house, which is $3,057 a year. They're going to lose $39,000 in appreciation. And the other thing I don't think about is if they renew their lease, they don't get any advantage of paying down that loan, those 12 payments, which would be around $8,400 that they would lose in lost amortization. So the total cost of waiting for them is going to be about $48,000. So you can tell the borrower, look, I know it's tough, but please don't give up, because we come back a year from now, these homes are going to be more expensive, interest rates may be higher, this is going to cost you an extra $48,000. Bid over ask. We know that these homes are going for over the asking price because they get so many bids. Have you had any buyers say, hey, wait a minute, I don't want to pay more than the asking price? They're looking at a home that's $450. Your advice is, look, this home shows great. If you want this home, you're going to have to offer $480. And they're like, what? I don't wanna pay more than they're asking. And they may even, you may have a discussion about comparable homes, and the home may be priced properly at $450, that's the market price. The listing agent did a good job, but it doesn't matter. There's so much competition, they're gonna have to pay more than market to get that home. So that's a concern. People don't wanna get in a house and be in the hole. But how much of a concern? With the appreciation rate in North Fulton, they're looking at taking 8 months before their equity, see, they're overpaying the dark purple portion, but it only takes 8 months before their equity catches up. And in fact, over the next 5 years, we expect them to get $132,000 in appreciation, so that makes that extra $30,000 look very reasonable and very affordable, plus the lifestyle of being able to live in the house that they want. Do you think that may help them make that decision? Great. Well, that's all my goodies. So any questions?